I'm Catherine Ross, and I'm here live from the NYSE with Jim Cramer. Jim, there's obviously a lot going on in the markets right now,
no kidding.
but I want to take a step back, and I want to get you unfiltered. What's on the top of your mind?
This WeWork deal, the arrogance of it, 3 classes of stock, losing huge amounts of money, insider dealings. It's precisely what smells of a top. I don't want that to happen. The bankers have to bring deals. That's what bankers do. I don't know many bankers who would ever say, you know what, let's wait. This is not the time. But this is not the time. Don't need it. You know, if you're a person who wants higher stock prices, the last thing you want is WeWork to come public, because it's just everything that I don't like about a deal is encapsulated in it. A company that's losing even more money than I thought, a company that has a lot of competition, a company that is unsteady, and as much as I like Newman, it doesn't matter. That's the zeitgeist of right now, is people are just talking, give me a break, WeWork, give me a break.
Now this morning we did see, albeit brief, an inverted yield curve.
You know, look, this market is all about the inverted yield curve. It's not about the fundamentals. And if it was about the fundamentals, I mean, I have a list of the top 50 companies in the S&P, and it's very hard to find, even in the top 20, there's only 3 that actually have something to do with the inverted yield curve. So what you're doing is you're just saying all stocks are worth less because the recession's coming. There's a pool of money that's going to be in stocks no matter what, and it's going to gravitate after the smoke clears toward the companies that do well in a recession. And I need people to go back to the 3rd week of April of 2000, and you'll see the beginning of the outperformance of the S&P versus the NASDAQ, and it's quite stark. Now, I don't think we're going to go into recession. I think we have enough talking heads who will take care of that for me. I do think that an inversion would stop if Jay Powell kept cutting, which he will. But I also think that if the government were to take advantage of the yield curve and issue a 30-year bond that was magnificent and big, it would be snapped up. But there's a failure of imagination in this administration that is palpable. They need to sell $500 billion worth of 30-year. Now, here's what happens. You're in the White House. You hear something like that. It's never been done before. Well, it's never been done before. Well, this yield curve's never been done before. So react. Take advantage. It's not necessarily the yield curve that's inverted. It's how you react to the yield curve that's inverted. And they're not showing any imagination. That's what you should do. Giant deal. Giant bond offering.
Now you said be careful, don't react, but I do want to take a step back because I want to ask you, the average Joe investor who saw this morning or was reading up on FinTwit about what the inverted yield curve means, what the history of it is, when the average Joe investor sees that and they start to panic, quite frankly, how should they approach it?
Look, if you think you can sell Procter at 116 and buy it back at 110, then do it. Maybe that's what happens. As we go to 1.5 for the 30-year, and we go to 1, and we go to half for the 10-year. I want to own high-quality stocks with good yields. I did the same thing in 2010. It was a very good game plan. My writing partner Matt Horween first turned me on to the AHYs. That's the accidental high yielders, and they're magnificent to own in the Great Recession. They'll be magnificent to own now. So let the market take stocks down. That's the way I look at it. Let the algos take stocks down. Keep some cash. That's what we're doing for Action Alerts. We do have a conference call later today that I want everyone to sign up for Action Alerts and listen to, because I'm not a panicker. I just don't panic. I just don't. I panicked in 2008 on October 8th. That was my last big panic. And I'm sorry, 1998. 1998. So we got 2008, 2009. The last time I panicked was 21 years ago. And if I panicked 21 years ago, and I remember probably panicking and how bad it was, then I will do the right thing today, and tomorrow, and the next day, and next week.
And we're constantly...
Panic's bad.
Exactly. You constantly joke with me about my tattoo, my Don't Panic tattoo, and why you believe in that. And there we go. That's exactly why. Okay, Jim.
We're talking about that. I've got some 5 stocks that you can take advantage of the volatility, because the volatility is going to be with us. Because the market's unsteady, and they're the ones that I think you can, if you feel so inclined as to take advantage of this curve, both long and short for all I care, but I like the long side. then by all means listen to our call. It's also funny. I got a very good story at the top that you'll like very much. It'll be worth it just to be amused by it, okay?
So Jim's call will be live on actionalertsplus.com at 11:30 a.m. Eastern this morning, so you have to tune in.
Look, we were up. How much were we up yesterday? A nice amount. Down a lot today, and down. We did a fantastic piece last night. Mark Sebastian, who is the real money VIX guy, he said this was going to happen, and let it come in, and then we'll be good. He said it will happen, and it's happening. And to me, that means, well, okay, now what do you do next, Mark? And Mark would say buy it. So I'm there. I wish we were more oversold, but the oversold keeps being relieved by days like yesterday. But yesterday was a very significant day because the president said he would stay the hand of the September tariffs. If the Chinese take the bait, well, you're going to be up 200 instantly. Do you really want to bet against that? I don't know. I mean, do I think the Chinese are going to do something? I have no particular insight. Do I want to sell stocks down 500 if they're up 500 yesterday? No, that's not what I want to do.
Jim, yesterday, as you mentioned, we got a reprieve from tariffs, for some tariffs until December 15th. Now, a lot of those tariffs a lot of those being reprieved did not include retail. But the joke on FinTwit yesterday in the headlines were all about how Trump is saving Christmas. I'm wondering, is retail still going to get hurt?
Yeah. No, I mean, look, if you're Walmart, if you're Amazon, if you're Target, if you're Costco, if you're Home Depot, you're going to have no problem with these. If you're a company that's struggling to begin with, you'll have a problem. Witness Macy's. So, I mean, what you want to do, we sold some Kohl's yesterday because we were afraid of Macy's. And then bingo, here we are. And it's just, it's ineluctable at this point. Mall-based stores are doing poorly. Why do we own Kohl's? Because they've got a special deal with Amazon. And it's got the great yield protection and the balance sheet's solid. But we knew that Macy's could take the group down, so we sold some Kohl's.
And Macy's is Real Money stock of the day today, which means that you can go to realmoney.com and find articles portraying what you need to do.
Right, but now we're going to switch to the club call.
We are?
Because I want to talk about what a preview of what I'm going to be talking about for members.
Yep.
Okay.
Including the 5 stocks. All right, guys, thanks so much for joining us. If you're on TheStreet.com or on Facebook, we are now heading, as Jim just said, over to ActionAlertsPlus.com for our daily rundown show. I'm Catherine Ross, and we'll see you tomorrow.